Boom! What's going on, Investomaniacs? Your boy Knight Rider here. And I know what you're thinking. You're like, Knight Rider, I thought you were dead. No, not dead. Just very, very, very inconsistent about making YouTube videos. Hey, it's only been like 4 months. I wonder why my channel isn't working. Anyway, let's talk about Roku. I just bought Roku on Friday after it reported. I liked how it traded down. I liked the quarter, and I'm like, all right, I'm ready to get back in. I've been in and out of the stock a couple times. I've made some good money in it, and hopefully I'll make money in it again this time. Before I talk about the quarter, I want to talk about something else, which is I was looking at the quarter towards the high end of this day on the 11th, which was like 2 days before it reported. I was looking at the quarter here towards the high end of the day. I just happened to, when I clicked on the stock, it was towards the high end of the day, right? And so it was like right about here. And I was thinking to myself, like, should I get into it? And I decided not to. I didn't like how the stock was trading into the quarter. And just between these 2 days, on the 10th and 11th, the stock had gone up over 14% compounding growth. 2 days, over 14% growth compounded between these 2 days. Not when it closed, but again, when I happened to be looking at it towards the high of the day. And I didn't think that was a good setup. And just look how big these 2 days of a difference can make. If you would have bought it like at the open of this day or the close of the previous day, you're down much below where it's been trading for the past several weeks. And in contrast, just 2 days later, if you would have hit it towards the high, you're now above where it was trading kind of over most of the past couple weeks. So how those 2 days can make a big difference in terms of just how much you're paying for the stock, but also in terms of the setup going into the quarter. Now, I am probably going to be holding Roku a little bit longer term. Not just for the trade, but I was trying to decide, hey, should I get in before the quarter or should I wait and see if, we're going to get a down draw after the quarter and then go in at that point. And I ultimately decided I would have bought it had I seen the stock down here, but I didn't see it here. And I saw it up here just 2 days later, and I decided it wasn't a good setup for the quarter. But I do like it here. So that's why I got into it. I put 30K into it, which is, I don't know, like 8% or whatever my portfolio. I have a 345K portfolio right now, so whatever that is. Now let's talk a little bit about the numbers. Well, first let's talk a tad about the quarter. And what people didn't like. Why did it kind of go up and then go down? So they did beat on the top and bottom. Those were stronger than expected, which I think is probably what initially pushed the stock up, but ultimately ended up down because they did have weaker than expected guidance. Now, I personally wasn't too scared about that because the reason for that is they were going to be pushing heavier, more aggressively into international markets. Obviously, that costs money. So if you're going to be kind of front loading those expenses, trying to ramp up your expansion internationally, that costs money. That means less profit in the short term. I was okay with that because I am in this stock for growth, or at least when I'm in the stock, I'm in it for the growth. And I'm not so concerned about short-term profit. I don't want to be losing too much money, but I'm okay with kind of breaking even. That's just my personal preference, right? But other people, they wanted the more short-term money, and therefore that pushed the stock down. But I took that as a buying opportunity. Now let's take a look at the numbers. Now, there are obviously other numbers, but I don't want this video to be too long. It's probably going to be longer than I want it as it is. So I'm primarily going to be focusing on what I think was one of the more important metrics that I look at. And then I'm going to explain a little bit to how I got there. So this is essentially going to be kind of like the equivalent of like a PEG ratio, but for revenue, since there's not really earnings, right? So this is our revenue, our trailing 12-month revenue for the past 4 quarters. This is the number of shares over the past 4 quarters because we want to take into account dilution. This is the trailing 12-month revenue divided by shares, so the revenue per share on a trailing 12-month basis. And this is where the stock price was trading at the low during a given quarter and the high during a given quarter. This was the quarter over quarter revenue growth percentage. So this is kind of a year over year for a given quarter. And we can see that the Q1 2019 much lower than Q through Q4 in terms of the revenue growth, much lower here at 36%. And this is the trailing 12-month year over year revenue growth. So this is Q1 through Q4 2019 revenue growth over Q1 Q1 through Q4 2018. Okay, that's at 52%. And again, Q2 through Q4 is all kind of roughly the same. A tad bit weaker here at at Q1, but still not too bad. And then I do a 50-50 split. So we're taking the most recent quarter plus the 12-month, and then we're dividing that by 2. So it's going to be weighting the most recent quarter more heavily, but that is something that I do. So I didn't actually exactly use this for my personal numbers, but I'm just trying to keep it somewhat simplified. So this is close enough. And now we're doing the price of the stock divided by the revenue per share, high and low for a given quarter. So again, the highs for the past 3 quarters are 19.3, 21.5, 15.27. Right now, we're sitting at 13.7. So that's obviously much lower than kind of the high points. And then the low points of price to revenue per share during a given quarter are 13.9. We're already lower than that currently. So that's good. And 12.6, we're not that much higher at 13.7, and 10.8, that is obviously quite a bit lower. But again, we also had kind of slower revenue growth. So now we're going to take that revenue growth into consideration, and we're going to take the price to revenue growth per share and divide that by the 50-50 split for the revenue growth percentage. Okay. Price divided by revenue per share divided by revenue growth percentage. Sorry if this is getting a little complicated, but whatever. I can give you fake numbers. I can give you the real numbers that I use. Okay. So again, here we're taking, this is for the high for a given quarter. We're taking the 19.29 price divided by revenue per share, and then we're dividing that by the revenue growth, the 50-50 split, which is 50.8, and that brings us to 0.379. And then we do the same thing for the low. Okay, so for the past 3 years, the high points are at 0.379, 0.40, 0.364, and right now we're at 0.27. That's obviously much lower than the high points of the previous 3 quarters. And now we look at the lows. We have 0.27. Again, we're already lower than that right now. We have 0.237. That's a good chunk cheaper. And then we have the 0.258, which is, we're only maybe, 4 or 5% more expensive than that right now. And remember, we have a lot more information and conviction in Roku's ability to scale and succeed with their platform business than we did in Q1. So that's not something reflected in these numbers, but just something I'm saying that although it was a little bit cheaper right here, we're so much more confident about their platform business. So we should be willing to pay a little bit more for that. So in reality, I think this is actually probably a bit better of a deal than this was if we don't take into consideration how much potential future growth is, because obviously it's the same business. The earlier you go, the more kind of future growth potential there is. But nonetheless, the point is, this is the only one that stands out as, a moderately cheaper amount. Having said that, whatever. It's not okay. So it's not the best possible place you ever could have bought the stock, but we're definitely towards the lower end of the range here. If you look at this 0.27, again, it's like not that much. 0.258, 0.274, 0.237. We're right towards that lower end of the range, and so there's not that much in terms of kind of downside risk, in my opinion, at least based upon this particular metric. But look at the upside potential that we have. We're at 0.27 in each of the 3 quarters. It traded all the way up to about 0.38. 0.4, 0.364. We're only at 0.27, so that's a lot of upside risk. So in my personal opinion, the numbers are saying this is a good buying opportunity. That's why I went ahead and bought. And I think if by the time you see this video, I do believe, if I had to guess, this is not something I bet my money on. I don't consider myself a macro guy. I don't bet the market's going to go up or down. But if I had to guess, I'd say the overall market is probably overextended right now. And I think the S&P 500 is ultimately probably going to come down over the next couple weeks or months or whatever. And if by the time you see this, the overall market has gone down and that's dragged Roku down along with it, I would take that as a further buying opportunity. So maybe you'll be lucky and get even a better entry point than I would. Anyways, hope you guys have a great day.